Have you ever really, truly stopped to think about where money comes from? I mean, we use it every single day, right? But its origin story? Well, it's one of the most misunderstood concepts in all of economics. Today, we're going to dig into an absolutely fascinating bulletin from the Bank of England that pretty much flips our common understanding on its head. So let's just ask that question right out of the gate. Where does money really come from? If you had to explain it, could you? You might say, oh, it's printed by the government, or something about a coin factory. And yeah, you'd be kind of right, but that only covers about 3% of the money in the entire economy. The real story, the other 97%, is way more surprising, and it has huge implications for how everything works. And this slide, this cuts right to the chase. We're going to tackle one of the biggest myths in economics head-on. The story we all learn is that banks are just middlemen. They take in savings from people like you and me, and then they lend that same money out to someone else. But the reality? Whoa. The reality is that commercial banks create brand new money basically out of thin air every single time they make a loan. Okay, so let's start with that story most of us heard in school. You know, the textbook version. It's this idea of banks as simple go-betweens. And on the surface, it really does seem to make perfect sense. Here it is, the classic story. You deposit your paycheck, the bank keeps it safe, and then it lends your money to somebody who wants to buy a car or get a mortgage. It's a neat, tidy picture of money just moving from one person's account to another's, through the bank. But here's the thing. As the Bank of England itself points out, this view, as popular as it is, just isn't how it works. Not anymore. It's a huge oversimplification. In our modern economy, the mechanics are completely different, and honestly, they're way more interesting. So before we get to the how, we first need to get on the same page about the what. What even is money really? If we're going to understand how it's created, we need a solid definition to work with. You know, what's so powerful about this is how simple it is. At its very core, money isn't a piece of gold or even a physical banknote. It's an idea. It's a social agreement. It's basically an IOU, but it's a very special one because we all trust it. You accept it as payment only because you know for a fact that someone else will accept it from you tomorrow. It's all built on trust. And for that trust to hold up, money has to do three key jobs. It's got to be a medium of exchange. That's what lets you swap it for a cup of coffee. It has to be a unit of account, so the coffee shop knows whether to charge you $3 or $300. And it has to be a store of value, so the money you earn today is still going to be worth something next week. Okay, you ready? This is where everything clicks. This is the moment the story takes a huge turn. We know what money is. Now let's talk about who is actually creating almost all of it. And there it is, the number from the Bank of England's report that just makes you pause. A massive 97% of all the money in the economy isn't physical cash. It's not notes and coins. It's just electronic numbers, digital deposits, sitting in commercial bank accounts. Think about that. All the cash you've ever held in your hand, that's part of the tiny 3%. So that leads to the big question. If 97% of money is just digital data, where on earth does it come from? And there's the answer, right there. It's created by the commercial banks we all use. Not the central bank, not the government printing press, but the everyday banks down the street. And the process, well, it's almost shockingly simple. When a bank gives you a loan, let's say for $100,000, they don't go into a vault and check if they have it from someone else's savings. No. They just type the numbers into your account. And in that instant, $100,000 of new money is created. It did not exist a second before. That is brand new money, added to the economy. The loan is the bank's asset, and the new deposit is its liability. They pop into existence at the exact same time. And look, don't just take my word for it. This is a direct quote from the Bank of England itself. It could not be any clearer. Making a loan is the act of creating new money. So this obviously brings up a huge question. I mean, if commercial banks have this superpower to literally create money out of nothing, what's to stop them from just creating an infinite amount and causing total chaos? Well, thankfully, there are some pretty important checks and balances. First, banks are businesses. They're not charities. They're only going to create a loan if they think they'll make a profit. Second, they have to follow strict regulations about how much capital they hold. Third, and this is a big one, they can't force us to take out loans. Our demand matters. And finally, watching over the whole thing is the central bank and its monetary policy. And this right here is the main lever of power. The central bank can't directly control the amount of money being created, but what it can do is influence the price of that money, the interest rate. By raising or lowering rates, it makes borrowing more or less expensive. So they don't turn the money tap on or off, but they do control the price of the water, and that ultimately decides how much of it flows through the system. Okay, so we've busted a major myth and uncovered a really fundamental truth about how our economy is built. But what's the big deal? What does this actually mean for you, for your finances, for how you understand what's going on in the world?
Well, it's because once you really get that, new money is created when banks lend, the economic world suddenly starts to make a whole lot more sense. All those headlines you read about interest rates, debt, and economic growth, they're not just abstract ideas anymore. They're all directly tied to this process of money creation.
And all of a sudden, so many of these complex topics you hear about in the news just click. You finally see why a slowdown in bank lending can kick off a recession. You understand how a central bank raising interest rates is supposed to cool down the economy. You can even begin to understand what something like quantitative easing is all about, because you now get the most important part. Our modern economy is fundamentally built on a system where money and debt are created together, two sides of the same coin.
And that leaves us with one last massive question to chew on. If the creation of almost all new money is directly tied to the creation of new debt, what does that tell us about the engine of our economy? It suggests that for our economy to grow, our collective debt has to grow with it. It's a pretty profound thought, and it completely reframes the whole debate about debt, growth, and the very nature of money itself.